Hi, John Dobis from Forbes here with Kamie Zaracki. She is the CEO of BetterInvesting. Kamie, nice to talk to you.
Great to talk to you,
All
John.
right.
I'm glad to be here.
All right, so I've heard of BetterInvesting. What is it?
So BetterInvesting is a nonprofit organization. We've been around since 1951, and we teach people fundamental investing.
All right.
So we've got lots of educational classes. We create some tools that reinforce, the principles that we teach and the methodology that we teach in the classes. And we're really all about helping people learn to become successful long-term investors.
So what do you have, like local chapters in many states and cities?
We do. So we have, we're an organization that founded investment clubs. So many people may know about the Beardstown Ladies.
Sure.
They're one of our famous investment clubs, and they're still around today. They're doing great.
Oh, they are?
They are.
They're better investors?
They are better investors. They're doing great. So anyway, we have a lot of investment clubs around the country, and our investment clubs are supported by our chapters. So our chapters are always a group of volunteers, so they're not paid or anything, but they're there. They meet with the investment clubs and help them to bring classes to them and kind of reinforce how to select a stock and how to manage your portfolio.
These organizations, they actually manage a real money portfolio, right?
Absolutely. So an investment club is actually a business partnership. So they pull in their own money. Many of them put in anywhere from $25 to $50 to $75 a month, each individual that's participating in the investment club. And they pull their money together and then they invest together. And most of our investment clubs actually use the investment club as the opportunity to learn and practice. I like to refer to them as the learning lab for investing, and then they take what they learn and they apply it to their own portfolio. So most club portfolios are under 100,000. However, we have some clubs that have well over $1 million in their portfolio.
So is it like investing into a closed-end fund? It sounds a little bit like that. You put money in, then you make portfolio selections, and you have a pro rata share of...
Based on your ownership. Yeah, I guess you could think about it that way. I mean, that's not the way we necessarily think about it.
In terms of regulation, you're not
right.
bad, right?
No, absolutely not.
Right.
Absolutely not. We're considered individual investors.
So you guys teach people about fundamental investing. What kind of fundamentals do you tell them to look at, and how do you evaluate those various metrics of a company?
Sure. So that's a good question. So we like to say that price follows earnings, earnings follow sales, so it all starts with sales. So we're always looking to see that a company has a nice sales trajectory and that we've seen it in the past. So ideally we like to have 10 years of history, but at a minimum we need 5 years of sales history because we're going to project it for the next 5 years out into the future. Now, that's not to say that it always needs to be perfect, but you're looking for a trend line that's generally going up. The other thing is that depending upon the size of the company, you expect it to grow at different rates. So a really large company, so a company that's got over $10 billion in sales, we'd like to see a target of anywhere from 5 to 7% of compounded annual sales growth. Medium-sized company, so between $1 billion and $10 billion, we're looking to see a sales growth that's anywhere from 7 to 12%.
Okay.
And if it's a really small company, so something that's under $1 billion
you want
in
double-digit
sales,
growth.
Exactly. In fact, starting at 12 and potentially going up to 15. Now, interestingly, there's some very large companies out there that are racking up double-digit growth.
Sure.
So we're looking for sales growth.
Then you go to earnings, right?
Then we go to earnings. You want to see earnings kind of following sales, so we don't want it really erratic. We want it nice and straight and smooth.
Company managements tend to like to do that too.
Exactly.
They do all they can.
Well, because honestly, that's a measurement of the quality of the management.
Right.
That's running the company.
Consistent, like GE did for years when it was really kicking tail. Cash flow, is that part of the equation, or?
Yes, indirectly. I mean, we want to see strong and growing pre-tax profit. We want to see strong and growing return on equity. Or at least flat, and we like to see declining or flat debt.
All right.
Now, the debt issue is one where it depends on the industry the company's operating in. Some companies, you need to be...
If you're a utility or if you're something like that, you've got to have a lot of debt.
You got to have a lot of debt, and also debt can be a measure of the company investing in its future.
This is true.
So debt in and of itself is not necessarily bad, but
so
you
when
want
you
to
come
make
up
sure
with
it's
stocks, then they're not just growth stocks or not just value stocks. Growth at a reasonable price stocks, maybe?
Exactly.
All right, I didn't even know it, but okay.
Yeah,
so tell me what are you looking at now? What are some stocks that might pass this
test?
criteria, this test?
Sure. So in Better Investing, like I said before, as a nonprofit, we don't necessarily make recommendations, but we do encourage people to study stocks.
Right.
So with that qualification, that I'm going to encourage
She's
everybody.
not recommending you buy these, but
I'm recommending that you do your own
check
analysis. I'm going to suggest that people take a look at a couple of stocks. One of which is Apple. And Google, for that matter. Everybody knows those two stocks. Everybody knows what those two companies are doing. And if you were to take a look at their sales lines and their earning lines, they're generally tracking up straight and parallel.
Now Apple,
Yeah.
this past year, or this current year, is expected to do something that it hasn't done for quite some time, and that is revenues to slip. That's
bit.
not going to, a little bit.
A little bit.
So, but it's still got a nice trend line that's going higher.
Right.
So you're not kicking it out of consideration.
No, because we are long-term investors. So we have a tendency, this is not a hard and fast rule, but we have a tendency to hold a stock for anywhere from 4 to 5 years. So
Okay.
we tend to look at it for a longer
So
term perspective.
Apple's a dividend payer, Google is not.
No, Google is not. But Google's actually, its stock price has been a little on the soft side lately. So
Not a bad thing always, right? I mean,
it's an opportunity to buy.
Right.
It's an opportunity to buy a good quality company.
you're talking about an outsourcing company?
Cognizant. Cognizant is another great company to take a look at. What's interesting about them is they also have strong sales, strong earnings. This is a company with almost no debt, and it has to do with their business model. So they're a consulting company. They got a lot of consultants around the world. While they're headquartered here in the United States, actually New Jersey, they have a lot of their workers that actually do the programming and so forth are in India
right.
and other places that have lower wage
Gotcha.
costs.
Gotcha.
So that helps with their earnings. So Cognizant is one that's a good long-term, from my perspective,
Sure.
looks like it's a good long-term play.
Then you had a couple more that you shared with me earlier. What else is on there?
So there's Skyworks.
Right.
So Skyworks is another high-tech company, and it's one that people should pay attention to. It definitely presents some interesting opportunities, but it's important to know that 40% of its sales come from Apple. So it's going to ride whatever Apple's doing.
You're kind of doubling down there on the Apple then, right?
Well,
With Skyworks.
But the thing with Skyworks is that they make components for wireless communication. So if they can, if the company can successfly start to diverse its customer base,
Right.
Then they've got, I think, some
So
great opportunities.
SWKS, CTSH, Apple, everybody, Google, GOOGL, right?
Yeah,
Or Alphabet, I guess we should be calling it.
Yep.
Anything else?
This one has nothing to do with technology, but
Right.
it's kind of a fun one. Cheesecake Factory.
Cake. Love it.
Cake.
Dividend
C-A-K-E.
payer, right?
Dividend payer. It's another one that in its industry of sort of casual restaurants, it's really one of the stronger performers. So, typically this is in the area of what, discretionary income.
Right.
So when the economy gets bad, this stock is going to suffer a little bit. But the strength of this company is really good management, and they have not overbuilt
Right.
too many stores around the
They
country.
have good food too.
They have excellent food.
I know. I come across a lot of these dividend payers, and one of them was Brinker International, the Chili's parent.
Okay,
Not a pretty chart. Similar story with Dine Equity, owns Applebee's,
okay,
which I think I've been to last in about 2004.
okay.
But this is the cake swims against the tide.
Yes, it does. It does. Great cheesecake.
So Google Better Investing, and maybe there's a chapter near
Here,
where you live.
Better Investing. There
So
you go.
there you go.
BetterInvesting.org.